Yeah, good morning, everyone. So nice to see you again today. And yeah, we will begin the very important uh, topics on derivative securities. And we'll start with forward and futures today. And in our next videos, we'll see options and then swaps. Okay, so let's go into our materials. Okay, so if should you have questions or comments, just talk on the mic, okay? So forward or futures, right? Forward or futures. We call it derivative securities. So as the name suggests, right? So you could easily guess that we are talking about something derived, right, from something else, right? That's why we call it a derivative security, right? So the value of this security is derived from something else, right? So how could we do that? That's the development of derivative securities since 1950s, but no, the fast pace of development has started happening since 1970s, especially since the publication of Black and Scholes option pricing model in 1973. So we call it derivative as the mathematical, you know, uh, connotation that sticks with the word derivatives, right? So let's say, uh, let's use someone here, maybe Varian, okay? Varian.
Yes,
Uh,
sir.
so let's say, Varian, you're making an agreement with Richard, right? So this kind of agreement, right, could be spot, could be forward by nature. You see, like, so for transaction, okay, for transaction or forward contract is frequently interpreted as the opposite of the spot, right? So what is the difference again? Spot means you're making you're making the deal now and you also execute it now. So again, the deal is made right now and the execution also takes place right now. So what we mean by right now is usually T plus 2. So we still define T plus 2 as a spot transaction, right? So yeah, about 2 days, or you could even include 3 days into the spot definition, right? So forward contract, on the other hand, you could imagine, uh, is showing something that we make the deal right now, right? You make the deal right now, but the execution would happen later. So again, what we mean by later would be like more than T plus 2, right? Maybe next week, maybe 5 days from now, maybe 1 month, right? Maybe 3 months, maybe 9 months, maybe 2 years, and so forth. Right? So the execution will happen or will be carried out later. Okay, so again, spot transaction or spot whatever spot items would mean the deal and execution are carried out or undertaken right now. Again, right now could mean T plus 2, right, maximum. On the other hand, the forward transaction is that the deal is made right now, but the execution would be carried out later. So we'll make a hypothetical situation where, let's say, Varian, right? Varian, you're making a deal with Richard, right? Let's say,
Yes, sir.
so in in the forward or futures market, we always use this term, long and short. Okay, long means to hold or to buy, right? Short, of course, is the opposite, right? So to let go or to sell. That's why you short it, right? So always use these terms, right? Instead of saying buying or selling. It's more I think more proper and more familiar in the derivative market to call them like long and short. Right? So let's say Varian, you're holding a long position, right? Give an easiest example for now. Maybe a MacBook Pro 2020, okay? MacBook Pro 2020 that usually will come out in June or July, right? So you long MacBook Pro, okay? Let's say at the price of 4,000 a piece, okay? And you could make whatever number of contracts you want, right? Maybe 1,000 contracts or 100 contracts and so forth, right? So you're taking a long position, right? Let's say the maturity or the expiry date of the contract is 3 months from now, right? 3 months. So it's about July, right? So you're making this forward contract with Richard, right? Meaning that Richard is taking a short position, right? Short position, again at 4,000 a piece for 3 months. Okay, so what will happen? 3 months later, right? 3 months later. So again, long position means the holding position, right? The buying position. So obviously, 3 months later, Varian will get whatever contracts you make. Maybe let's say 100 contracts, right? Between you, 100 contracts. So 3 months later, Varian will get 100 units of MacBook Pro, right? 16-inch MacBook Pros at 4,000 a piece. So the contract is valued at 400,000, right? So Varian will get the MacBook Pro by paying 400,000 to Richard, right? So Richard will have to deliver 100 units of MacBook Pro and receive 400,000. Okay, so this is a simple, simple example and illustration of the forward market, right? So again, the deal is made right now. The deal is made right now, but the execution, again, will be carried out sometime in the future, right? Sometime in the future could mean 1 week from now, or even 5 days from now, right? But again, usually the limit for spot transaction is about T+2, or maybe the most, at most T+3, right? Okay, so we'll see a lot of examples later. Okay, so before we go into the some technicalities, let's see various types of futures contracts that we have at the world level and also at in many countries. Right? You see grain there. Grain is again the staple food of especially the Western civilization, like grain, animals and meats. You see cows, pigs there, and then food. Chocolate is a hot commodity for forward and futures, and then fiber and metal. See some metal there, quite famous and familiar metal categories that we see, like gold, silver, platinum, palladium. Right? Palladium is usually made for ring. University graduation rings are usually made from palladium. In some countries, we don't have such culture, but again, in many Western culture or Western universities, we have that, the graduation rings. Of course, we are not talking about the NBA championship rings, right? They are made of gold, of course. And then oil, petrol. So I think you're following the news that even the futures price for crude oil has turned sour, right? Has plunged into zero and some sort of negative zone because there's no demand for it. So oil futures price for May has turned negative or close to zero because there's no demand and there are not enough places to store the oil, right, and store tanks and something like that. And then wood, right? And then the financial futures contracts, you see interest rate futures, market indices, market indexes. You'll see a lot of examples there, and of course foreign exchanges. Foreign exchanges we'll see the difference between the forward and futures. Right? But for the futures contracts, the foreign exchanges are quite limited to the famous and mostly used foreign exchanges in the world. So for foreign exchanges, they are not included into the futures contracts or the market for futures contract. We have to do, we have to make deals and transactions in the forward market. So we'll see in a little while the differences. So for now, you see the the items or categories that we have for especially for the futures markets, and they keep developing, right, from year to year or even from day to day. So there are a lot of innovations that take place from time to time. Okay, so we'll come back to it later. So why are we doing this kind of transaction, right? The derivative securities. So returning to this discussion on the portfolio formation, right? Portfolio management, right? So I hope you still remember, right? So I've made videos on portfolio theory in 2 parts, even in 3 parts, and you know the essence of the portfolio management again is to manage the risk, right? So to reduce risk. Unfortunately, with the portfolio management, we could only reduce one type of the risk. What risk is that? Is the idiosyncratic risk. We call it idiosyncratic or specific risk. Right, specific risk. So again, as suggested by the name, you see specific risk refers to risk suffered by a certain business unit or a certain institution independent from the risk of other institutions. So we call it specific, right? For example, you have a portfolio of many assets, right? Maybe one of your business units or one of your assets went down, right? Went broke, just because it couldn't compete with, you know, other competitors, other businesses in the industry and so forth, or it just made like wrong strategy and something like that. Okay, so specific risk. Unfortunately, the other type of risk, which is the market risk, or we can call it beta, right? Market risk or macro risk or whatever name you could use, right? The systematic risk is undiversifiable using the portfolio management. Why is that? As the name suggests, again, system means the whole system, right? So systematic risk obviously refers to risks suffered by the whole economic players in the system, right? So the whole, you know, the whole economy, all business and economic players in that system suffer from the same risk. So you can name them, right? Inflation risk, interest rate risk, even foreign exchange risk, political risk, right? Anything else like interest rate, we mentioned it. All the macroeconomic type of risk, right? So systematic risk. So if everybody or every player in the economy suffers from the same risk, then this risk is not diversifiable, right? We could not diversifiable this risk using the portfolio management. Why is that? Because again, you have a lot of assets in your portfolio, and all of them, let's suppose that all of them live or stay at the same ecosystem, right? The same system. Right? If the system is attacked, for example, this condition, right? It's the healthcare crisis is attacked by a new strain of, you know, plague, right, or virus, and the whole system suffers from similar risk. So this is called systematic, right? Undiversifiable using the portfolio management. That's why then the idea of alleviating or even eliminating the systematic risk, has to, harness like further techniques, right? Further techniques than the portfolio management. That's why we are doing the internationalization, right? So you go international, right? You go international again by shifting to another continent or another country. You are shifting the system, right? You see, that's why you're doing internationalization of your business, right? You go international. So you try to become a multinational corporation, right, or something like that. So by internationalizing your company, then you try to shift to another system or to other systems. Unfortunately, this also has seen a decrease in its effectiveness because more and more countries and even regions are converging, right? Converging into, due to the globalization. So we were saying, you see, the Eastern world is more and more heading toward the middle, right? Of course, Eastern countries cannot become Western countries. Right? How can we? Right? But Western countries, in the same spirit, are also converging to the middle. So you see, the globe, right? The globe will become a big country of itself. That's why the effectiveness of internationalization in decreasing or in uh, even eliminating the systematic risk has decreased, right? The function or the effectiveness. But the second one is still effective, and I think will be effective forever. This is what we call the hedging, right? Hedging and insurance. And this is part of what we call the big theme of risk management. This is where we are right now. Okay. So we are here. So we try to manage and even eliminate the systematic risk using the hedging techniques, one of which is the derivative securities transaction for hedging purposes. Okay, so you see the big idea there. So what is the main use of, again, the derivative securities? Actually, the main function or the main utilization would be for hedging purposes. Hedging purposes. Okay, so now let's talk more details about hedging. So what is the main meaning of hedging? See the English word there. Hedging comes or stems from the word hedge. And interestingly, the word hedge actually means what? Gate, right? So you try to gate something, that's why, again, the popular definition of hedging would be protection, right? So to hedge something is popularly defined as to protect the value of something, right? Why to protect the value of something? Again, the word hedging comes from the word gate, right? Hedge. Hedge means gate, right? So you try to protect the value of something, and that something here would mean your assets, right? Or your securities, or your even your physical assets and so forth. So you try to do the hedging mechanisms because you try to protect the value of something. So why you need to protect the value of something? Let's see the modern world, okay, in modern times. So let's imagine in the past, right? Maybe in 1950s or even before the Second World War, uh, actually the world had been facing, like similar situations, albeit with different complexity, of course, right? But actually, the world is repeating itself from time to time. You see that situations actually are repeating, right? But in more, I think, more complex or complicated fashion. So let's say in 1950s or even beforehand, uh, you are, let's say you were an owner of an airlines company, right? Airlines firm. Very easy example, right? So as an airlines firm, even since some decades ago, and this still remains the same, right? What is the most dreaded thing, right? The most, or the thing that you fear the most? in managing your expenses or your costs? Of course, the oil price, right? The oil price, the fuel. Fuel is I think the most expensive component, right? The most expensive cost component in the airlines industry, right? The fuel, you can call it simply like gasoline, such as that for cars or motorcycles, but fuel for the aircraft, for your aircraft, right? This is the most expensive one. And even to make it worse, the fuel price has to follow the oil price. And as we know, right, oil price is always uncertain, right? And is impacted by many factors, many of which are beyond our control as a company. For example, because of the Gulf War, right? Because of the deal made by the OPEC and whatever, the political situations, non-economic factors that will affect the fuel price. Okay, so it's something uncertain, right? Highly uncertain. So this is something that you are dreaded the most, right? And what are you afraid of? Of course, increasing price, right? Increasing fuel price, not decreasing. If the fuel price decreases, you'll be very happy, right? You jump with joy, right? Because the fuel price suddenly drops, and you make more and more profit because of that. But increasing price is something you don't like, right? You fear for. Right? So let's imagine again in 1950s, and you did nothing, right? You were the top executive, maybe you were the CEO or even the owner, and you did nothing to do it to handle or manage the situation. You just didn't care, and you said nothing you could do, right? So what will happen? Let's say this is your business, right? This is your main business. If the fuel price did increase, let's say it's about 5 decades ago, right? If the fuel price did increase, what will happen to the cost? Your cost will soar, right? Your cost would soar, and of course the profit would go down, right? Profit would go down, and there's a possibility that you became like not competitive, right? Less competitive, and then you went broke, right? So if you did nothing, then you just hope that the fuel price remains stable or even decreased if possible, but not jumping right significantly, right? Not increasing significantly at a short period of time. So you did nothing, right? So if the cost did go up, then your profit went down, and you might go broke as well. But what would happen to you in the past, like in 1950s or 40s? And nobody would punish you, right? Because you had the appropriate reason at that period of time, right? At that the olden time, and you could say that nothing you could do. You had served your customers well. You had designed and implemented excellent strategies and so forth, right? So nothing wrong with the business acumen, business strategies that you conducted and implemented. So you said nothing you could do, right? So it's just uh, the act of nature, right? This is like natural risk that you couldn't avoid and prevent or even manage, right? But what about now in 2020, for example, or in the 20th century? If you do that, definitely you will be fired, right? You'll be fired the next day. Why? Because you do nothing. You do nothing to prevent or even to take opportunity of the situation. Okay, you see the time difference, right? The development of the finance and economics techniques to handle such a thing. Okay, so that's why now we are doing this, right? Hedging mechanism. Again, hedging mechanism is a mechanism that you take to protect the value of something, right? The value of your business. So how can you do that? Very easy principle. Even non-finance or non-economics people could imagine the situation. So you try to reverse the situation, right? Reverse the situation. So you're making the hedging contracts or derivative, right? Derivative contracts. And for today's session, we're talking about one of them, right? Forward or futures, right? So let's use this analogy, right? Very simple analogy. So if you're afraid of if you're afraid of an increasing price, will you buy it? Will you buy the thing first, or will you sell it first? Very simple, right? So if you're afraid of increasing, yeah, anything, right? Increasing maybe computer price or automotive price, will you buy it first or will you sell it first? Of course, you will buy it first, right? You'll buy it first. You're afraid of an increasing price or something, then you try to buy it first, right? So if you are afraid of increasing price, then you take a long position, right? What about decreasing price? Let's say you are afraid of decreasing oil price. Should you sell it now or should you buy it now? Of course,
Sell, sir.
you will sell it now, right? So in a condition under a circumstance where you are afraid of a decreasing price of something, then you will try to sell it first, right? Sell it right now before the price goes down. That's why you take a short position. Very simple analogy, right? So we will apply this technique everywhere, forever, okay? Very simple, right? So take a long position, take a buying position if you're afraid of an increasing price. And on the other hand, uh, you take a short position if you fear for a decreasing price of something, right? Okay, so let's return to our example, right? So as an airlines business, right, airlines firm, again, you are afraid of the increasing price of oil, right? Because again, once again, right, if oil price increases, then your cost will go up, right? Will skyrocket and profit will go down, and maybe you're not competitive enough to hire talents to develop your business or even to buy new aircraft. Then you might go down, right? You might go broke. So what should you do now in the derivative contract, right? In your hedging contract? Yeah, you are afraid of increasing oil price. So what position should you take, long or short? Of course, it's a long position, right? So you take a long position, right? So long, for example, oil forward or futures, right? So you long oil futures contracts or long oil forward contracts, right? Take a long position. Why you're taking a long position? Because you're afraid of the increasing oil price. So you see here, right? The determination of the positions, right? Be it a long or a short position, don't rely on your feeling or hunches or even strategy, okay? Because we are doing the hedging mechanism, right? We're doing it for hedging purposes, not for speculation purposes, right? So actually, the determination of positions simply depend on no, the situation that you are facing, right? Because now you are facing the uh, oil situation where you're afraid of increasing oil price. Okay, so let's make the scenario. Okay, let's say within so you're making the oil futures for maybe 6 months, right? 6 months. So 6 months later, it turns out that the oil price does increase, right? So what will happen to your business? Are you happy or unhappy in your business? Oil price increases, your cost structure deteriorates, right? And then your profit goes down. So in your business, you are unhappy, right? Because of the increasing oil price. You are unhappy, right? But remember, 6 months before, you made this contract saying that you would uh, you you held a long position, right? So buying position, and the oil price and the oil futures consequently oil futures price also increases, right? So you made a buying position 6 months before at a lower price. Now the price increases, then you are happy here. Okay, so your happiness uh, is expectedly could compensate for the loss or the losses that you will make in your main business. This is called hedging, right? This is called hedging. This is why you are protecting the value of something by by trying to reverse the situation by making a contract, right? A derivative contract somewhere else. So what will happen if the situation that you feel for doesn't come to pass? So they just doesn't happen, right? Let's say the oil price even decreases. So about your main business, maybe the situation right now, oil price suddenly drops, right? Then you're super happy here, right? Super happy because suddenly you make more profit without even your individual performance. It just happens because of the like money coming from the sky. Okay, oil price goes down, so it's not your performance, not your strategy whatsoever. Oil price just decreases, and you gain additional profit out of the blue, right? Out of nowhere. Okay, so you are happy there. However, remember 6 months before you took a long position in the oil futures, and the oil price goes down. So definitely you have made the contract at a higher price than the current price 6 months later. So you are unhappy here, but it's okay, right? Because again, the main purpose of making the derivative contract is not to, oh, where is it? Not to make profit, right? But to compensate for the loss, compensate the loss or potential loss that you will suffer from your main business. So you might be unhappy here, but again, you in your main business, uh, you improve your profitability. You get again the money from the sky, so it's okay. Right? It's like just like an insurance, right, to the business. Okay, so this is uh, the main purpose of making the derivative contracts. Right? But again, an instrument can be used for many things, right? And we cannot blame people for misusing something, right? If some people are using derivative contracts for speculation purposes, it's certainly their private rights that cannot be blamed, right? But of course, it carries like a high amount of risk that of course, they have to assume and bear. Okay, so let's imagine if I mention uh, like the vapor for mosquitoes, like Baygon. Okay, it's a famous brand like Baygon. If you ask what is the main function of Baygon, of course to kill mosquitoes, right? To kill mosquitoes. However, some people have been using Baygon in combination with whatever, with the benzene, right? The gasoline. They combine it, they plus carpanax or something, right? And they get high, right? So you cannot blame those people, right? It's their right to do it, but of course it's detrimental. It's damaging to their health, and of course it threatens their lives as well, right? They would die, right? They could die, and many people have died because of the dangerous combination of Baygon or something like that. But my point here is that we cannot just then blame or stop the production of Baygon because you are saying that okay, Baygon has been misused by many people as the uh, high uh, ingredients or substances, right? Because Baygon, the main purpose, right? Or we could say it this way: the existence of Baygon purpose to kill mosquitoes, right? So similarly here, you see here, derivative contracts are created or were created to hedge risk, right? To help corporations and individuals hedge or protect the values of their assets. Okay, not as speculation instruments or something. But again, some people will use the derivative securities as speculative instruments, and of course we cannot prevent that from happening, right? But again, the main idea here is that something or everything is made for a purpose, right? So the main purpose of derivative contracts again is for uh, hedging transactions, hedging mechanisms, not as speculative mechanism. Okay, so again, this is easier said than done. Okay, so I would recommend that you watch the movie Rock Trader. Right? You see human problem there, psychological and also technical problem. Right? This is about the Barings Bank, right? Bankruptcy. So it went down because of one person, because of one trader. That's why we call the guy a rock trader, right? Then the title of the movie is Rock Trader, and this was played by famous actor right now. Back then, he was not that famous, Ewan McGregor. So I would suggest that you find the movie uh, and watch it. It's about the derivative contracts at its earliest, earliest stage in Southeast Asia, right? In Singapore and in Jakarta. Okay, so uh, that's what I'm saying, right? It's easier said than done, right? If you think about it, from our discussion like just now, derivative contracts purport to hedge the risk of someone, right, or a corporation. Right? So this is for hedging, right? The main use is for hedging purposes. However, some people, or even many people, are using it for speculation, right? For speculative purposes or trials, right? And we are saying that this is the right use. Speculation is not the right use. Okay. However, no, in real life, you can imagine a situation where the use of derivative contracts for speculation purposes is actually very tempting and appalling, right? Very compelling. So imagine if you were a CEO, right? What should you do? What should you do to succeed in business? You could mention many things, right? You must have what? Excellent products. I could write it down. Maybe you could talk about it for 7 days, even, right? There are a lot of things that you have to do to succeed in leading your business, right? Excellent products. You should satisfy what? Customer, right? Customers. So customer satisfaction has to be maintained and even improved from time to time, right? What else? Uh, good finance, right? Profitable business, right? Good strategy, right? And so forth, right? So on and so forth, because you could mention many other things. So my main point here is that every day, every morning you wake up, right? You have to start thinking about this kind of things, uh, how can i how can I improve my products, right? How can I improve my customer satisfaction? How can I increase the value of the firm? How can I change the strategies to adapt to the new environment, right? Or to just to respond to like competitive or competitors' moves and so on, right? So it's quite a big headache, right? Every morning you have to think about it and something. What about the derivative contracts, such as forward or futures, derivative securities? You see what's that, the uh, myopic situation in which you see that this is easily determined, right? Long or short, right? So you get myopic, right? Every morning you wake up, you're saying that, okay, I will take a long or short position, just two choices, 50-50. You're playing Baccarat, right? You're playing Baccarat, right, in the casino. Just no logic, nothing, right? I want to take the banker or player, similar thing, right? So wake up, you're thinking, okay, this morning or last night I got a dream and I would take a long position this morning without any logic, right? And maybe for the first like 3 days, so you made the right choice for the 3 consecutive days, and that makes you even more encouraged and spirited. And now you declare that you're the expert of the guessing game, right? You're the expert of making prediction or something like that. So you try what? You start forgetting your main business and focus on the gambling part, right? This is the problem, right? Human problem. So it's very easy for us to say that, okay, derivative contracts are primarily, or not even primarily, but essentially should be used for hedging purposes, right? Should be used for hedging mechanisms and not for speculation purposes. But again, the human psychology would push you to the brink of logic, right? And someday you're saying that, okay, the business makes a big headache to you, right? Headache situation to you, and suddenly you start saying that, okay, derivative contracts are easier or are an easier place to make money just by simply choosing between what long and short position, and that's really dangerous, right? Very dangerous decision that you take, right? If you do it that way. Okay, so again, if you summarize, the logic, right? The main purposes before we go into the technicalities, right? So derivative contracts should be used for what, hedging purposes, not for speculation purposes. However, if people do the like speculation purposes, we cannot blame the instrument, right? The instrument is there for the right purpose. Again, imagine the uh, mosquito vapor, right? Like Baygon, right? It is made for killing mosquitoes, not for getting high, right? So if people are getting high because of that, it's like their personal choice, their personal decisions. But we cannot blame the instrument. We just have to, uh, uh, enforce the law, right? Uh, inform people more, right? And again, the law enforcement would be, of course, number one in that case. But in the derivative transactions, I think we have to uh, give more information uh, and also to uh, increase the customer base of the derivative traders. So this would become a norm, right? That they are used mainly for hedging purposes. Okay, so we are going to see the technicalities. Okay, now we'll see the differences between forward and futures. And along the way, we'll see a lot of we get a lot of information, right, from the differences. The first one is offer the counter versus an organized exchange. So you see, you're saying that forward contract is made uh, between corporations, between individuals, like what Varian and Richard did, right, in our example. So they made a forward contract. It's offer the counter. Offer the counter means that everywhere you can make it freely by yourself with agreements or negotiations and the agreements by the counterparties. Right? On the other hand, futures is traded on an organized exchange. So let me show you. This is the example there. Yeah, yeah, easy to see. Now, in the forward contract, as long as we have a buyer and a seller, right, then you can do the forward contract again, like what Richard and Varian did in our example, right? However, to make sure that both parties are satisfied and trustworthy, usually the counterparties, right, both the involved parties will hire a market maker, maybe an investment bank, maybe a commercial bank or another institution, a consulting firm or anything that could function as a market maker, as an intermediary. Right? What about the futures market? Futures market, again, is uh, sold on an organized exchange. So we have an exchange floor here. Right? Exchange floor. For example, we have the futures exchange, right? The famous futures exchanges in Philadelphia, right? In Chicago, right? At the world level, right? And of course in all big cities in the world. So we have, because this is traded on an exchange, it is equipped with a lot of institutions, right? Like the supporting or peripheral institutions. So to buy or sell, right, long position or short position, you need to go through your brokerage firm, right? Just similar to the stock trading that you have been doing, right? So you need a brokerage firm securities firm to undertake or to execute your transaction. And again, it's equipped with clearing house or clearing houses and guarantor. Okay, so let's see an example here in the country of Indonesia. So some regulations there, the newest of which was enacted in 2011, right? And we have institutions in the US. Of course, we have the CFTC, the famous CFTC. In Indonesia, we have like a Ministry of Trade. We have BAPEPTI, right? Commodities Futures Trading Supervisory Board is equivalent to the CFTC in the US. Right? And the exchanges, we have Jakarta Stock Exchange. Now we call it Indonesia Stock Exchange, or IDX. So on the IDX, some commodities, not so many commodities, but like LQ45 index futures is sold on the Indonesia Stock Exchange, or the IDEX, right? But we also have other futures exchanges like the JFX, Jakarta Futures Exchange, and the Indonesia Commodities and Derivative Exchange, or ICDX. Okay, so the IDX itself, the Indonesia Stock Exchange, also sells an index futures, right? An index futures that we will see in our example later. Okay? And then clearinghouses, you see for the stock trading, we have the Indonesia Clearinghouse, right? We call it KPEI, right? KPEI, Indonesia Clearinghouse. And for the futures transaction, we have the Indonesia Futures Clearing. So like supporting institutions, right? And we have brokers and traders, futures advisors and fund managers. Of course, we have custodian banks, and we have the custodian central as well. We call it KSEI, right? The central custodian. Right? We have custodian banks under and again, this custodian banks will manage the escrow accounts or separate accounts, right, for the transactions, and have the information system and so forth. So again, the futures securities, because they are traded on an organized exchange, then the transaction would be supported or equipped with a lot of supporting institutions. Right? Okay, so forward contract is mostly not traded. Of course, we could trade it as well. Right? Just most of the time not traded, and futures contracts are of course traded, right? Traded. So again, it's quite compelling that we have seen a previous example, and sometimes because of this kind of trading, it seems easy to make money, but actually it's not, like pure speculation. Why is it speculation? Because you make the forward or futures contracts without any underlying situation, right? Different from again the previous situations where you had the airlines business, right? But if you have nothing, if you have no underlying transaction, then you are doing the speculation, right? Speculation. So maybe along the way I'll give maybe another example. Let's say you're an exporter of handicraft, okay? Handicraft from Central Java. So as an entrepreneur or manager of the handicraft company, so what are you afraid of in terms of the foreign exchange risk? Let's say the USD to IDR, IDR per USD. You are afraid of what? The depreciation of US dollars, right? Depreciation of US dollars, because let's say you make your products in Indonesia and you sell them to the United States, you sell them to Europe and wherever, right? In other countries. Now we have the IDR per USD. So if you are an exporter, you export the handicraft, you are afraid of the depreciation of USD, or you don't like if the US dollar depreciates, right? Okay, so using our previous logic, what should you do in your derivative contract, in the forward or futures contracts that you're going to make? You are afraid of the decreasing value of US dollars, right? The depreciating US dollar. Of course, you have to take what? A short position in USD, right? You're afraid of decreasing or depreciating USD, then you have to take a short position, right? So short US dollar. So you see, this example can make it clear for you. Why are you taking a short USD but not long, right? Not short in IDR and other decisions. So again, your decision is determined by your situation, right? This is not determined or made based on your feeling or your analysis or your strategy or whatever, right? This is purely and solely determined by your situation. Because you are an exporter, you are afraid of depreciating US dollar. So you short USD, right? You short USD, not because you don't like USD, not because of your excellent analysis or something like that. Again, one more time, right? You short the USD only because you're afraid of the depreciating USD in your main business, because you are a handicraft exporter. Right? Okay, so let's say you take the contract for 3 months. Okay, take contract for 3 months. So what will happen 3 months later? Let's say because of the improvement in the Indonesian economy and something like that, USD does depreciate. Okay, maybe from whatever 16,000 per USD, right? Now it has like 3 months later, it has become whatever 15,000, right? So the dollar is depreciating, right? So are you happy as an exporter? Of course not, right? Because now your dollar revenues are translated back into rupiah and in a smaller amount, right? In a smaller amount, okay? So you are unhappy as an exporter due to the depreciating US dollar. However, remember 3 months earlier, you made the contract, right? A short position in US dollar. So, for example, you took a short position at 15,800. We'll see a lot of examples actually, but this is for the introduction, right? And let's say 3 months later, it has become like 15,000. So you see now. So made you made the contract to sell $1, right? Sell $1 and get 15,800. 3 months later, people who don't have this contract will sell $1 and get 15,000 only. So are you happy? Of course you are happy here, right? Okay? Because your contract says that you could sell $1 and get 15,800. Right? On the other hand, 3 months later, people who don't have the contract will sell $1 and get only 15,000. So again, the profit that you make from the derivative contract is expectedly to compensate for the loss that you'll suffer from your main business because of the depreciation of US dollar. Right? Very easy, right? However, again, if you do the derivative contract without any underlying situation, then you are doing the speculation, right? If you do it without any cause, just because you want to try to make more money, then you are doing speculation. And again, why speculation is quite compelling, because the money involved seems quite spectacular, you know? Good money in a short period of time. So you can imagine, give you now the example, we have on the IDEX, IDEX Indonesia Stock Exchange, right? LQ45 index futures. This is futures, right? This is traded on the IDEX, right? LQ45 index futures. So if you're doing the speculation, right, doing the speculation, that definitely you have no underlying situation whatsoever, right? You just want to bet on, the increasing or decreasing index, right? But if you do it because of the underlying situation, then you are doing the hedging purposes. So let's imagine this is for the hedging purpose. Let's say you have a portfolio of assets, portfolio of stocks. So the portfolio of stocks, this is the value of your portfolio, right? And then this is your, this is the prices, right? Make it more precise. Prices of your assets, and this would be the value of your portfolio, right? So let's say you start the weighted value of your portfolio is here, right? You start from here. If the prices or the values of your assets increasing, then you are happy, right? This area, you see, you are happy, no problem, right? You're just happy. You don't have any concern if prices increase. But what you don't like here, what will make you unhappy, what you're afraid of is this part, right? If prices decrease, for example, in the recent 2 months, 1 or 2 months, right, you're seeing decreasing stock prices, right? So you don't like it here. So you could come to this instrument, right? Because you're saying that let's suppose that your portfolio consists of many blue chip stocks, right? Many good stocks that are actually part of LQ45 index. This is a blue chip index, right? Blue chip index. So you're saying that if many of your stocks experience like decreasing prices, then most likely the LQ45 index is going down as well, because most of your stocks, most of your assets are part of the LQ45 index. So they are like blue chip stocks. So you're saying, what should I do to earn money, right? To reverse the situation? If if the if my stocks and also the LQ45 index decreases, how can I make money from it? Long or short position? So you are afraid of decreasing value of the index, right? So obviously you are taking what? A short position, right? A short position. So let's see now what would happen, right? Your portfolio and your LQ45 index futures. Right. Let's say prices do go down, okay? So they go down. So in the perspective of your portfolio, of course, you are unhappy, right? You are very unhappy. You're making loss here. However, for your LQ45 futures, remember you have made a short position, right? And the price or the prices go down. So the index, consequently, the index is going down as well. So you have made a short position there. So you take you have the commitment to sell at a higher price than it is right now. So you are happy, right? You could sell it at a higher index. Okay, so you are happy there. What if the situation that you are afraid of doesn't come to pass, and in fact your stock prices go up? You're happy, right? You're very happy because contrary to your expectation or your forecast, actually your portfolio value goes up. However, remember you have made the short position, right? You have made the futures contract taking a short position while the index actually goes up. Right? So you are unhappy here because you're selling at this point, right? But actually the value right now is higher than the contracted point that you made. So you're making a loss here. You are unhappy here, but it's okay, right? It's like it's like an insurance, right? So it covers, it could cover your main position, right? Your main portfolio position. Okay, again, this is called hedging. However, the attractiveness of doing speculation is really really real. Okay, this is not something like in the imagination or something like with like Fata Morgana or something like that. But this is very real. Right? Now, I'll give you an example. Okay, LQ45 index futures will give you a multiplier effect of 500,000 per point. No joke, right? This is quite good money, right? So this is how it works, right? For example, you're taking a contract for 2 weeks, and you're seeing the contracted price. Contracted price for 2 weeks, let's say, is 900, or let's say 900, right? So this is a contract for 2 weeks from now, right? 900. But again, the deal has to be made right now, but the execution would be within like 2 weeks or 2 weeks later. Okay, then if you're doing the speculation, you don't have any logic, you don't have any underlying situation nor underlying asset whatsoever. You just go there to try to make profit, right? So you bet on the situation. Let's say you're taking whatever you want to take, okay, long position, because maybe you're saying that your analysis shows you that the index will go up because it has been down for a while, and it will rebound, right? It will go up within 2 weeks to 900. So you decide to take a long position without any underlying situation, right? So you see a long position with the duration of 2 weeks at 900, right? So let's see what will happen 2 weeks later, and let's say what you have bet actually comes to pass, right? So the index turns out to be 910. Are you happy? Super happy, right? Because they took the long position at 900, and 2 weeks later, actually the real index or the real value of the index future is 910. So obviously you are making a profit of 10 points, right? 10 points. And as I say, one point has a multiplier money of 500,000 per contract. So per contract, you are making what, 5 million IDR in 2 weeks. And assuming this is only one contract, what if you are making 100 contracts? Suddenly in 2 weeks, you are making 500 million. If your guess or your bet is correct, right? In the correct direction as what you want. However, unbeknownst to you 2 weeks earlier, but again, now 2 weeks later, the value of the LQ45 index is 850. Oh, then you will cry, right? Definitely you will cry because, again, you took a long position. Like 2 weeks ago, you took the position. You have taken a long position at 900. Right? 2 weeks later, when it matures, right, it expires, the real value is 850. So you took the long or buying position at 900. Now the real value of 850, then you are losing 50 points multiplied by 500,000 each. This is a multiplier value per contract. Suddenly you are losing how much per contract? 25 million, is it? Right? 25 million, is it? 25 million per contract. And if you have made 100 contracts, you can imagine, so you're losing 2.5 billion in 2 weeks. No joke, right? Serious problem, right? It could create pose a serious threat to you, to your financial situation. Okay, so this is speculation, right? That's why this is very compelling, because if you're in a myopic situation, thinking that you could predict anything, that your analysis is 90% right of the time, or any kind of the imaginary thoughts that you have, you're thinking that you could beat the market most of the time, then okay, they go for speculation, speculative action, and this is very compelling but super dangerous. So again, I want to repeat again, the main purpose of derivative transaction is for what? For hedging purposes, right? Not for speculation or speculative purposes. Okay, we'll continue with the third one. Credit risk borne by both parties. Right? On the other hand, we have seen that the futures market is equipped with many institutions, including clearing house or even clearing houses, right? It's very similar to the stock trading, right? We have the clearing house, right? And so does the futures market, right? Market self-regulating. Coming back to our earliest example, like Richard and Varian, they made their own contract, so they basically they regulated themselves, right? Maybe they hired an investment bank or securities firm to be the market maker, so they could do it, right? But here, this is regulated by official bodies, and we have seen here in the U.S., in Indonesia, in Germany, in other parts of the world, every country will make its own regulations and laws, and they would create institutions to uh, manage the futures market. Size and delivery date of contract is determined. Though this is, I think, one of the uh, what's that? The interesting or the attractive factor of the forward market, right? Because the size and delivery date of a contract is determined by ourselves, by counterparties. So in our example, you see, like Varian and WeChat or any other examples, we could make our own contract. Right? On the other hand, for the futures market, because this is traded on an organized exchange, contract size and delivery date of a contract are standardized. So we have to follow, right? We can only take it or leave it. So one example would be the this one, foreign exchange. Right? See, the futures contracts are quite limited to famous currencies, right? Like US dollar, Euro, well, Swiss franc, Canadian dollars, Australian dollars, Singaporean dollars, Japanese yen, and some famous currencies. So what if a German company that wants to do business in wherever in Indonesia, right? And they want to hedge against the rupiah depreciation because they need to bring the money back, right, to Germany. So they don't want like depreciating rupiah to affect their profitability. So they want to short rupiah, and of course we couldn't find IDR in the futures market, right? So we have to do it in the forward market, right? In the forward market. And because we are doing in the forward market, then the size and delivery date would be determined by the counterparties, by the involved parties. On the other hand, in the futures market, we have to follow the contract size and delivery date. For example, for Japanese yen, I think per contract is like 12.5 million per contract. This is the size that we have to follow, right? So you take it or leave it, right? Take it or leave it. You cannot bargain in the futures market. If you want to bargain, then you have to do it in the forward market. Right? You make your own contract with another counterparty, another bank, or another company, or so on. What about the uh, GBP, right? Britain pound, British pound. This would be, I think, 62,500 per contract, and then the euro would be 125,000 per contract. So again, the sizes and the delivery dates are determined by the market, right? So we can only take it or leave it, right? Take a position or leave it, right? If you want to bargain, you want to negotiate, then do it in the forward market. Next one, mostly settled by actual delivery, and for the futures market, less than 1% is settled by delivery. This is not necessarily true, okay? Not necessarily true. This is just the what's it, the common practice, or I think the evidence, yeah, most evidence shown by the industry, okay? So this is very easy to imagine. Why some companies want to do the physical settlement or physical delivery? Why some don't? So this depends on actually the necessity, or uh, something that you really need in your real business. So let me give you an example. So I used to work for an agricultural firm, one of the biggest in the world. So every 6 months, we had to, we needed corn, okay, corn for making, predominantly making the animal feed, but of course also for other purposes, right? The common food and some other things, but uh, this mainly was used for animal feed, right? For making animal feed. So we have to make sure every 6 months that we have the corn coming to our warehouse. Okay. So again, now train your imagination now. What is a situation that you don't like or you're afraid of if you were such an agricultural firm? Of course, you are afraid of what? Increasing corn price, right? Increasing corn price. So what position will you take? Of course, long position, right? Long position, because you're afraid of the increasing corn price. So we would take long position from time to time. Okay, let's say every 6 months. Now think about it, right? 6 months from now, of course, the first reason why I took the long position in corn forward or futures was because I was afraid of the increasing corn price. But second reason, also a very important one to this business, is that I want to make sure, right, that the corn is really available, right? That the corn avails to my business, right? Because I really need it for making animal feed and some other food, right? So 6 months later, uh, not only will I settle the transaction financially, but I also want the corn to come to my warehouse. Right? This I will settle this forward or futures contract physically, okay? Because I really want the corn to get into my warehouse. Okay, so I have two things now, right? Not only do I care about the increasing corn price, but I'm also concerned about the availability of corn from time to time because I don't want my production to cease because of the unavailable corn. And I have to hold my production because of that. Okay, so you get it, right? On the other hand, maybe we come back to our example, right? Exporter example. So what are you afraid of again? If you export handicraft to Europe, right, to Germany, to France, to other countries, you're afraid of what? Depreciating foreign currencies, right? Let's take an example, euro now, right? You're afraid of depreciating euro, right? Because you get money in euro, right? You sell to German buyers, right? To French buyers, right? To Italian buyers and so forth, right? So you're afraid of depreciating euro, right? Decreasing value of euro, and as and we have simulated, you have to take a short position in euro, right? To hedge the situation, to hedge the potential loss, right? So let's think about it, right? 3 months or 6 months later, do you really want to deliver the euro because you're taking a short position, right? So theoretically, taking a short position means that you will handle the thing you're selling, right? You will hand in the thing and expect the another thing uh, to receive, right? So if you need a physical delivery, it means that 6 months from now, you will take, let's say, 1 million euros of yours, right? You go to your counterparty or to the wherever your brokerage firm or anything for the futures contract, and you will deliver the 1 million euros, right? And then you receive anything in return, maybe US dollar or IDR or anything. Do you really need that in this example? I don't think so, right? I don't think so. Because you are just concerned about the depreciating euro. So that's why you will just settle the contract financially. For example, 6 months later, right? Let's say you made the contract at okay, this is a contract. So you took a short position at this rate, right? And let's say the expiry date is like 3 months, right? So 3 months later, let's say what you're afraid of comes to pass, okay? Now euro has become only whatever 16,000, okay? For the sake of example, this is just a hypothetical situation. So 3 months later, the euro has become a 16,000 IDR per euro. So again, in your main business, you are unhappy, but you took the short position, right? Look at the contract. The contract says that you could sell 1 euro, short position, like selling position. You could sell 1 euro and receive 16,900 IDR. 3 months later, people who don't have the contract will sell 1 euro and get 16,000 IDR only. So you are happy, right? You could sell more. You sell 1 euro and get more, okay? So your profit would be what? 900, right? This is your profit, the payoff for you, 900 per euro. And you can multiply by the size of the contract, multiplied by the number of contracts. We'll see that later. Okay, so this is the profit that you make, and you care about this, right? Actually, you don't really want to deliver the euro physically, right? Although you are taking a short position, you just care about the difference that it will make because of the contract. So you're making the profit here, you settle it, and hopefully the profit would compensate for the loss in your main business. So you only care about the financial what's that, the financial side, right? So you gain the profit, you get the money, the difference, but you don't really want to deliver the 1 million euros to your counterparty. Okay, this is 1 million euros, where's my IDR? You don't really need that, right? You don't really need the physical delivery of the contract, right? Very different from my first story for the agricultural firm. So of course they care about the potential increase in corn price. But secondly, and not less importantly, okay, this is also very important, they care about the availability of the corn. That's why they need the physical delivery, not only the financial settlement or the calculation of the profit or loss, right? Created because of the contract. Okay, I hope it's quite clear here, this point, right? That's why the evidence shows that futures contract has less than 1% physical delivery or physical settlement, right? So mostly settled financially. So we calculate, right? So I make, in our example here, I'm making like profit of 900 IDR per euro multiplied by the size of the contract multiplied by the number of contracts that I have made, right? So I just need to calculate and then I settle it, right? Okay, so next one, I'll skip this one, okay? Skip this one first because this is a quite big discussion. So the last one, because forward contract is by nature, this is not really for trading, right? This is just that contract between two counterparties or 3 or 5 or whatever number. So the difference difference in the bid and ask prices would prevail, right? There's no transaction fee, nor trader fee or something like that, because naturally this is not for trading. But for the futures contract, this has transaction fees, right, or trader fees, apart from the bid and ask spread that would appear, right? Imagine your stock trading, right? It's very similar to stock trading. So you have the bid price, right? The offer price, you have the bid price, and then of course you have to pay the transaction fees as well, right? The buying and selling transaction fees. Similar here in the futures contract. Okay, so I hope it's quite clear, because now we'll see this point, right? The very interesting point about the margins, right? So forward transactions or forward contracts are mostly between counterparties. So margins or margin system is not necessarily required. So not required doesn't mean not allowed. Look carefully, right? So we still can do the margin system for the forward market if the market maker requires them to do it. Okay, so this is not required, right? Not required doesn't mean not allowed. So this is still allowed, right? But not required. On the other hand, for the futures contract, because we do it in the in organized exchange, the margin system is required. So we call it what? Mark-to-market mechanism, right? Or marking to market mechanism. So what does it mean? Very easy to guess, right? Marking to market mechanism. It means that the value of the futures position has to be reconciled to the market value every afternoon. Okay, so we'll talk about it in more details now, the technicalities. So I want to go back to our earliest example, right, between Varian, right, and Richard. Varian and Richard. So this guy takes a long position. What was that again? The MacBook Pro, right? Long MacBook Pro at a certain price, say $4,000.
$4,000, sir.
$4,000, yes. And Richard is taking short, right? Short
Yes, sir.
MacBook Pro at 4,000. Maybe for 100 contracts. So let's say again the expiry date is 3 months from now. Right? So simple example, right? So imagine 3 months later, the real price of the MacBook Pro is $4,500, $4,500. All right. So simple question now. Who is at loss here? Who is at loss? Varian is taking a long position to sell it at 4,000, right? Richard is taking a short position at 4,000. Who is at loss here?
I think me, sir, is
Yeah,
taking a
Varian.
loss here because I
Yeah.
must pay more $500 more
Okay.
in 3
So
months.
look at it again, right? Varian has the commitment, right? Varian is committed to selling the MacBook Pro at 4,000, right? And Richard again has a commitment to sell it at 4,000, right? Okay, now the real price 3 months later is 4,500. So who is at loss? Richard, right? Because Richard has the commitment, right? Is committed to selling a MacBook Pro at 4,000, right? And the fact 3 months later is that the real price of MacBook Pro is $4,500, right? So this guy has to sell it at a lower price because it's the contract price, right? This guy will get it at a cheaper price. So another simple question: who has a higher possibility to run away? Richard, right? Of course, right? Because he's losing money, maybe he will disappear, right? He will disappear. So this is the main reason why where we need the marking to market mechanism, or the margin system, right? This is the reason. So with the forward contract, this kind of risk, this kind of the running away or something, this kind of risk will be borne by both parties, right? Plus, of course, maybe you have a market maker in the middle, right? An investment bank or something like that in the middle. But essentially, the risk is borne by the involved parties, right? So if Richard runs away, then Farian will be losing, right? Because now you're losing the contract. You could buy it at 4,000, although the actual price in the market is already $4,500, right? But Richard has been disappearing, so you get nothing, right? So this could happen in the forward market. That's why they also has a market maker. And going back to our discussion here, right? For the forward market, the margin transaction is not required. Not required doesn't mean not allowed, right? You still can do it, right? For the futures market, this is definitely required. So let's see an example now. Okay, so margin system. So the margin system, let's say you open an account, right, in your securities firm or in your brokerage firm, and then your brokerage firm tells you this, asks you this. So what do you want to do? You say, I want to do like a futures. I want to make futures contracts for maybe euro. Again, coming back to your situation as an exporter, exporter to Germany, maybe. So you say, I want to make futures contracts on euro, and then your brokerage firm will tell you this. Okay, the size. This is a futures contract, right? So you have to follow everything. So you take it or leave it. Cannot bargain, right? If you want to bargain or negotiate, you have to go to the forward market and make it by yourself, right? Or maybe the currencies or the commodities that you want to make, you want to contract are not available in the futures markets. Then you have to do it in the forward market. Let's say the size for euro is 125,000 per contract, okay? So your brokerage firm is telling you to do the transaction, they require you, right? So initial margin. So this one will be determined by your brokerage firm, but this one is determined by the international standard, okay? This is determined by the international standard, so you cannot do anything, right? And also the dates, right? Delivery dates, the expiry dates, this will follow the international standards. So you cannot bargain it. But initial margin and the maintenance margin are mostly determined by your brokerage firm. So maybe your brokerage firm will tell you, right? Initial margin is anything like maybe 3,000, okay? This is a hypothetical amount, right? Because this would depend on your brokerage firm. And your maintenance margin would be, they tell you, whatever, yeah, $2,000 per contract. Okay, this is the information that they tell you. Okay, you want to take it? And maybe you say, okay, I'll take it. So this, again, the size is, let's say, 125,000 euros per contract. And then the dates, maybe you want to take the intermediate one, maybe 6 months, okay? You take the 6 month delivery date. So you have to take one of them, right? This is given. You can only take it or leave it. But initial margin and maintenance margins are determined by your brokerage firm, each 3,000 and 2,000 respectively. So let's see what will happen to you, right? Again, you are an exporter of handicraft, right? Handicraft products to Germany. So you are afraid of, you make money in euro, right? So you are afraid of depreciating euro. Imagine that you bring the money back. When you translate the euro into your IDR, you are unhappy if the value of euro decreases, right? So you are afraid of depreciating euro. And what position will you take? Of course, short euro, right? You're afraid of the depreciating euro, so you short euro. So let's see now on your screen, your computer screen, maybe it shows that the contract for 6 months between euro and US dollar is, let's say, the contracted price, right? So this is the futures price, right? The price of the contract, right? So 120 at $120 per euro, and the again the maturity or the expiry date is 6 months, right? So here's the idea, right? The margin system is the part of the package of what we call marking to market. Marking to market mechanism, right? So you see, as the name suggests, marking to market mechanism. So we try to always reconcile or adjust the value of this transaction every afternoon. That's why we call it like marking to market mechanism, or marked to market mechanism. You can call it that as well. So let's see now, day one, right? So you've got the contract in the morning, for example. The contract price is 120 per euro, but the expiry date is still 6 months from now. But you have to do this every afternoon, right? Marking to market mechanism. Okay, afternoon number one. Afternoon number one shows that the futures price has become whatever, 117. So easy question. Are you happy or not in that afternoon? Your contract says what? Your contract says that you're taking what? Short, right? Short euro. So the contract says that you could sell euro, 1 euro at $120. Let's assume that you only take one contract, okay? Only one contract. So the size of the contract is 125,000. Right? The size of the contract, 125,000. So again, the contract says that you will sell 1 euro for $120, right? So you see that afternoon, right? Day one afternoon, people who don't have the contract could sell 1 euro and get 117. Are you happy or unhappy? You're super happy, right? You see, the contract says that you could sell 1 euro. You're taking a short position once again, right? You could sell 1 euro and get 120. In that afternoon, people who don't have the contract will sell 1 euro and get 117. So of course you are happy, right? How much is your happiness? Let's calculate now. 3 points, right? So your happiness in money is 3 cents per euro. Multiplied by, let's assume for the sake of example, for the sake of brevity, you only take one contract. And one contract, again, see the information here. The size of the contract is 125,000, right? 125,000 euros. Okay. So can we calculate how much is it? We'll calculate using my calculator. $3,750, right? So how much money do we have now? So we have we get additional 3,750. Our initial margin is 3,000 per contract. See here the information here. So now our money is, wow, happy day, right? So our money would be 3,000 at the beginning, initial margin, plus 3,750. So at the end of that day, right, the first day, we have a cash of 6,750 in that account, right, for one contract. So what can you do with the money? Now you have excessive amount, right? Remember you only need to maintain how much? 2,000. And now you have 6,750. What can you do with the money? First, you can cash in, right? Very natural. You ask, you tell your workers, I want to withdraw money, right? WD, right? WD, withdraw. So the famous term, right? WD. I want to withdraw, right? So you could withdraw the money. Second alternative, you can ask your brokerage firm to buy additional assets, right? Additional contracts or other assets or whatever. So you ask your brokerage firm to buy other things. Right? And third alternative, the easiest one, what is that? Do nothing, right? Let the money stay there, right? Stay in that account. And let's assume the third alternative that you do, right? So you do nothing, you just let the money stay there for nothing, right? So you do nothing. Okay, so day number one, well, still long way to go, actually, right? In the real life, but of course, for the example, we'll stop at some point. But day number two, right? Afternoon number two, let's say the price has become what? 115. Are you happy or unhappy? Wow, even happier, right? Even happier. Remember, in the morning, see, this situation tells you that in the morning, your contract says that to sell €1, you will sell €1 and you will get 117, not 120 anymore, right? Not 120 anymore because you have settled it. Yeah, essentially, you have settled it in the previous afternoon, right? 120 to 117, right? So now when you begin the second day, actually your contract says that you sell €1 and get 117. Right? And now in the afternoon, people who don't have the contract will sell €1 and get 115. Are you happy or unhappy? Super happy, right? Additional happiness. How much is your happiness? Now let's calculate. 2 points, right? Times, let's say that you only do one contract. You only made one contract, right? So, is it 2,500? I think. Yeah, 2,500. So your money would be how much right now? So how much is it? 9,000 something, right? 9,250. Wow, you have plenty of money, right? So no concern whatsoever. So you can continue the third day easily without any constraint, right? So day number three. Now suddenly this becomes ever 119. So third day afternoon, are you happy? In the morning, your contract says that you will sell €1 because you're taking a short position, short euro, right? You'll sell €1 and get 115. Okay? In the afternoon, people who don't have the contract could sell €1 and get $119. Obviously, you are unhappy, right? You're unhappy. Your contract says that you will sell €1, short euro, right? You sell €1 and get 115. Whereas people who don't have the contract in the afternoon could sell €1 and get 119. So what is your loss? 4 points. Times so how much is it? 4. So $5,000, right? So minus 5,000. So you're losing 5,000 that afternoon. So let's calculate how much money do we have right now. So 9,250 minus 5,000, so it's like 4,250. So this is still above. This is still above the maintenance margin, right? The maintenance margin is 2,000. So you're safe to go tomorrow, right? Still above 2,000. You have no problem at all, right? To continue the next day. Okay, it's still above 2,000. Okay, so let's see next day. Day number 4. Okay, so it's become like 122. 122. Happy or unhappy? In the morning, your contract says that you short euro, right? You sell €1 and get 119. In the afternoon, people who don't have the contract could sell €1 and get 122. Obviously, you are unhappy, right? You are unhappy. Your unhappiness is what? 3 points. Okay. Then you multiply by again the size of the contract, and you only buy one contract, right? We are assuming here you only buy one contract, right? So we could calculate easily. And 3 points, 3 cents multiplied by 125,000. How much is it? 3,750, right? Okay, now see the situation. Minus 3,750. So how much is it? 500. Oh, here's the problem now. So the amount of money in your account at your brokerage firm is only 500, right? And the maintenance margin is supposed to be 2,000, right? The maintenance margin is 2,000. So you obviously the amount of money is not sufficient to continue the next day, right? So they will do what we call what? Margin call. They'll give you a margin call that night, right? They'll tell you, okay, the amount of money in your account is 500. To continue this contract tomorrow, and you only have one contract, right? To continue the contract tomorrow, you have to fill up the money, right? You have to again fill up your account, right? With how much? How much do we need? We need 2,500, right? See, here's the thing, right? 5,000 is already below the maintenance margin, right? 2,000. So if you drop below the maintenance margin, you have to fill up your amount up to the initial margin. See, right? So 500 is below 2,000, right? If it's below 2,000, you have to fill it up to the initial margin. So the brokerage firm will tell you, right? If you want to continue this contract tomorrow, you have to send me 2,500 right now, or at most tomorrow morning, right? If you don't do it, what will happen? They will suspend your contract, and they could auto settle your transaction, or auto buy and auto sell. They will close down your position if you don't want to do the margin call. Okay. So again, one more time, right? Now the amount of money is 500. It's below the maintenance margin of 2,000. Because it drops below the maintenance margin, you have to fill it up to the initial margin. So you need to add 2,500 that night or the next morning at most. If you don't do it, then they will suspend your contract and they will do the auto whatever, right? Auto sell or auto close or auto closing of your contract. Okay. So the continue our simulation could continue, right, until day 180, right? 6 months, right? About 150 or 180 days later, right? We can do it continuously. But here's again the essence of the marking to market mechanism. Okay, marking to market mechanism. I hope it's quite clear. Really easy to imagine. Okay, so what will happen now? For example, in day number whatever, right? Day number 8, and let's say the contract is day number 8. The contract has become 15. And then suddenly you change your mind. You're saying that I don't need this hedging anymore. Or maybe you're bored with the contract or any other reason. You're saying that, okay, I don't need it anymore. The hedging mechanism is sufficient. You don't want to continue until day 180. So what can you do? There are two possibilities, right? You have a physical delivery, which is unlikely here because you don't really need the dollars, right? You don't really want to like hand in the physical euros, and then to get the physical dollars, you don't really need that, right? You're only concerned about the like depreciating euro, so you want to make sure that if euro does depreciate, you get money from here. This is what you want, right? So you don't need the physical delivery, but you want the settlement, right? The financial settlement. So again, after day 8, maybe you're bored, or you think that, okay, I don't need this hedging anymore. This is sufficient. Then you do the settlement. How can you do the closing by settlement? You just need to reverse your position, right? So remember, in this contract, you are taking a short euro position. So how to close it down? Then you take long euro position. Then all the cash flows uh, will be canceling out one another. Okay, so at first you have the short euro position. If you want to close the contract down, you just need to reverse the position. Now you take another contract with long euro position. Then again, the cash flows will cancel out one another. Quite easy, right? Quite easy imagination. So in summary, we could say that forward is probably a bit more compelling or attractive because of its freedom, right? Futures, what is the main advantage here? It is safer, right? It's safer because it's like organized by a lot of institutions, right? The exchange itself, the clearing house or clearing houses, right? The guarantors, the the central custodian, and also the custodian banks and other supporting institutions. So this is safer, right? Safer. But the forward contracts are more attractive because you have more freedom. Let's imagine a situation that, again, coming back to the exporter, you are an exporter, and let's say you have an exposure, right? Your exposure is like 200,000 euros. Now here's the problem, right? If you do the futures contract, remember the size of the contract is 125 per contract, right? And again, you're afraid of depreciating euro, so you take short euro position. But how many contracts can you do, right? Now you're confused, right? If you take one contract, then your exposure is larger. So it's not enough, right? You see the situation. One contract is not enough for you because your exposure is 200,000. But if you take two contracts, it's excessive. It's also dangerous, right? Excessive means that you contract more than in higher amount than necessary amount, right? So it's like another type of speculation. So taking one contract is not sufficient. Selling two contracts is excessive. So that's I think the limitation or the weakness of the futures contract, but it's safer. So forward contract is somehow more attractive, right? Maybe more beneficial as well to many corporations because of its freedom, right? The freedom that it offers, right, compared to the futures contract. So we have seen the differences, right? Of course, there are a lot of other technical differences in more advanced conversation or advanced discussion. uh, but I think so I think the last part of the last section of the first part of the futures discussion, right? Will be about the valuation, futures valuation. Of course, in the next video, we'll see how we technically hedge using the forward or futures contracts, right? So we'll see how the, let's say, the risk management system works, right? For especially for a financial institution, right? That will be discussed in the subsequent video on the hedging using forward or futures contracts. Right? But for now, we'll end this discussion with the valuation. So there are two possible again positions, right? Long and short. So let's imagine first strategy. So you're selling the contract. So this is short position, right? Short position. So imagine if you're taking a short position in a futures contract, it means that at the end of theoretically at least, right? At the end of the contract, you have to deliver something, right? That's why we could call it what, a short position or selling position, right? So at the end of the contract period, you have to deliver something, right? Maybe a currency or a commodity or some other some other assets. Okay, so here's the logic, right? How to determine the valuation. If you take a short position, let's see from here, from outflow, right? From the outflow. So you will deliver something at the end of the contract, right? At the end of the contract. So let's assume now you borrow money, okay? You borrow money. This is the principal amount, right? You borrow money, and then you buy what? You buy that thing, right? Maybe you buy the euro right now, you buy the oil right now, or you buy you buy the LQ45 index right now, or whatever, right? So you borrow money, and then you buy the thing, right? You buy the thing that you are going to deliver at the end. So remember, when you buy it, then you can invest it right now, and you get something here. Can you imagine, right? So you borrow money, you hold the asset, and of course the asset will produce something, right? Get the benefit. So you get inflow, right, from the benefit. However, remember, because you borrow money, you have to pay the interest, right? So what is the outflow here? You borrow money in the beginning, right? And then you have to pay the interest. So at the end, you have to repay the principal and of course the interest, right? But remember, when you borrow money at the beginning period, you could buy an asset, right? Be it again oil or euro or whatever, right? Or index or anything. Then you could invest it, and hopefully the investment will give you a proceed, right? Proceed. And of course, at the end of the period, when you deliver the asset, you get the futures price, right? The contract price. So you see the configuration here. The cash inflow, right, is F plus YP, right? And under the equilibrium situation, again, under the equilibrium situation, they should be equal, right? So no, what's that? No profit, right? No arbitrage profit opportunity, right? So what's that? The future value would be P plus RP minus YP, right? So they have the same P here, right? Same P. So we could rewrite it as, oh, let's use the easier here. So this is the inflows, right? And under the, again, the equilibrium situation, this should equal, what's that again? P plus RP. So if we rearrange it, P plus RP minus YP, right? And there's the same P here. So then we rewrite it. P plus, what is that? P R minus Y, is it? Okay, so this is the first, this is the value, right? The futures value. Or the, what's that? The value estimate of the futures contract. At least the theoretical or fundamental value of it. What about we'll prove it from the second strategy. So what is it? Buying, right? Buying. So long position, right? Long position. So let's imagine long position. Long position means at the end of the contract, you will get something, right? You get something. Okay. So what will you get here? So at the end of the contract, you will get something. You will get the asset, right? So now we analyze again the outflow and inflow. So imagine because you will get the thing at the end. Let's say you sell it now. Okay, so this is just again the scenario just to imagine the value estimate, right? Because you get the asset at the end of the contract, right? You get the thing at the end, right? So now let's say you sell it, and when you sell it, you get money, right? You get money. So you sell it now because you know that you get it at the end, but you sell the asset now, and then you invest it. And of course, with the investment, then comes the proceed, right? Maybe the interest, maybe the return, or any other types of proceed. So what's your inflow? So the money that you get from selling at the beginning, you sell it at the beginning because you know that you get it at the end, right? So but you sell it now, you invest it, you get the results, right? So P plus RP. So what about the cash outflow that you have to pay? Of course, when you get the thing at the end of the period, you have to pay, right? You have to pay. And now think about it. This is quite interesting, right? Actually, you suffer from the opportunity cost, right? So you get the thing at the end of the period. If you have, imagine, right? Should you have the asset at the beginning, you could have earned something, right? You could have earned whatever proceed from the thing that you get at the end of the period because of the long position. So this is the opportunity cost, right? The opportunity cost, so yield that could have been earned if we have that asset at the beginning. Okay, so now the cash outflow is F plus YP, right? And the cash inflow is P plus RP. So one more time, right? For the long position scenario, you get the item or the asset at the end of the contract because it's long position, right? Long position. So suppose now you sell an asset now and then you invest it, then this is the money that you will get, right? And what money will you pay or will you incur? Of course, the contract price at the end, because you get the thing that you pay, right? You pay that amount. And also, we imagine that if we had the asset at the beginning of the period, we could have, used it to produce something, right? So we have the opportunity cost here, right? The proceed that we could have earned if we had the product earlier. Okay, so let's equate the two equations again. F plus YP under, again, the equilibrium situation, F plus YP should equal P plus RP. So again, we move it there. Okay. And P plus same P here, right? P R minus Y, right? Exactly the same, right? Exactly the same using the two simulations or two scenarios. Okay, so this is the value, the value estimate of a futures contract, right? A futures contract. Okay, I think that would be the discussion on futures, right? The talking points about futures, forward and futures contract. Uh, and of course, we'll continue with the next video on how to use the forward and futures contracts to hedge, right, against risk, right? Especially for a financial institution. I will see how we could use the interest rate futures and also the currency futures and credit derivatives, right? To hedge, especially the risk for financial institutions. Okay, so thank you very much for attention for today's session. We'll see you next time in other topics. So, bye.